Hey guys, it's That Dividend Guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, we're going over the overall portfolio performance, the individual stocks, my buying power, and the stock I bought. I did not do it on camera simply because I put the order in on Friday, which was Good Friday, and I didn't realize that the market wasn't going to be open. So, my bad there. But as of today, we are down $546, down about 1%. The 1 week mark, we are up $719, up 1.37%. The 1 month mark, we are up $1,876, up 3.64%. That 3 month mark, we are up $3,611, up 7.25%. Then we are up $3,614, up 7.25% since the start of the year. Then the 1 year mark, we were up $3,164.22, up 6.3% for the past year. And then all time, since April of, I believe it's 2018, I want to say. Yep. We are up $18,109 and have a 51.25% return all time. So guys, my buying power changed because I have 98.15. I did buy a share of Google, and that's exactly where we are going to start off today. So jumping right into the portfolio, we are up $3.78 today. We only have one share. Market value, of course, is $156.05 because that market value is going to be exactly what is reflected in the stock price simply because we have that one share. Our average cost is $155.47. 0.29% of the portfolio is in Google. Today we're up 61 cents. In total, we're up 61 cents because technically it bought today. So I did add Google to the portfolio. I'm going to let the rest of that money sit. And of course, when Realty Income pays us next month, and at the end of the month, we also have that Altria dividend payment, which is over $300. We'll have about $450, and then we'll just do what we want to do when that hits the account. Then starting off with the first dividend payer, Realty Income. Sitting at $53.56 right now, 170 shares, $9,100 worth of market value. Average cost is around $65 per share. 17% of the portfolio is in Realty Income. Today we're down $90. Total we're down $1,950, down about 17.5% on Realty Income. Guys, this is a great cost on average opportunity. I would have bought 3 shares of Realty Income if I didn't buy that share of Google. So I'm not opposed to adding to the position here. I just want to build up a couple more positions that are smaller, like Coca-Cola. And I do want to add Visa relatively soon as well. If I had enough cash flow to buy a share of Visa instead of Google, I would have, but I didn't have quite enough. I was about $30 short of buying a single share of Visa, so I'll do that next month. But overall, guys, this is a great cost on average opportunity for Realty Income. It's just, it's already such a big position that I want to focus and allocate new capital to those smaller positions to kind of even it out. Because a lot of the positions in the portfolio are pretty big, double-digit positions, which is fine because a lot of them are big because they've grown over time. But I do want to kind of even out my exposure and not be so heavily weighted in just a few companies. But next up, we have Coca-Cola. This is one of those smaller positions, but it is one of my favorite companies. So today it's sitting at $60.80, down 38 cents today. We've got 15 shares, around $900 worth of market value. Average cost is right around $61 per share. Today, the portfolio percentage is sitting at 1.71%. That will be going up with time. Today, we are down $5.70. Total, we are up $3.83. We have a small, like 0.5% return. So this would still be a pretty good buying point for Coca-Cola. It is a little bit above my average cost, but close enough that I don't mind. I don't usually like averaging up, but when it's something like, 50 cents or something like that per share, it's not as big of a deal for me. It's when it's like $40 per share, then I don't want to add to it. But as you guys can see, we do have a dividend coming in on April 1st of $7.28. I'm getting paid for all 15 shares. Coca-Cola pays 48.5 cents per share. So that'll be some nice passive income. And I do like having some smaller positions in the portfolio because I've built up positions over the course of 5 years. So I've been investing since I was like 22 or 23 years old. So a lot of times when newer investors see those big positions, they think like, okay, well, something like, so let's just look at like Altria, right? So Altria is a huge position sitting at $13,000. So starting out, that is really intimidating to new investors. So I kind of like being able to add some smaller positions because it shows the actual journey of dividend compounding, of compound interest. Because sometimes when people start, you know, they're starting 5 years into my journey, right? So, and I didn't actually show my whole journey on here because I didn't start until a couple of years into investing. But starting out a position gives a live, like a live trajectory of that dividend income. So it might only be $7 now, but once it's 100 shares, it'll be like $48.50, right? So it's cool to kind of restart a new position from zero and build it up in front of you guys, simply because you guys didn't get to see that huge Altria position be built. Abbvie was made in like a week, so, and that was before I was investing. So this is just kind of one of those live demonstrations. I love Coca-Cola. It is one of my favorite companies. It will be one of the bigger companies in the entire portfolio given time. But this is one of those live demonstrations on starting a brand new position that's smaller. And, you know, starting out, people might say, oh, it's $5, oh, it's $7. Like, you know, you can't even buy a 12-pack of pop with that dividend. And, you know, a lot of times when you start out, it's really hard because you don't feel like you're making a lot of progress, because 48 more cents is not that big of a deal, right? It's not something to write home about. It's not like you're going to be able to pay your bills with that money. But if you never start small, you don't compound into something greater. So I'm excited to start purchasing Coca-Cola stock and building that position once I get, you know, the companies that I want. I still want to add like Berkshire and Meta, and then Visa, and then I will start adding more to the core positions, which I want Coca-Cola to be a very big position for this portfolio. So this is one of those kind of rare instances where it's a position that I'm a fan of. I felt like it was a little overvalued and I jumped in. So now you guys kind of get a live walkthrough of how I invest, and watching it go from something as measly as $7 to, you know, eventually however big it gets. So I just think it's cool to be able to kind of start from zero on a couple positions, so you guys can see how, you know, a measly $7 can grow over time, especially if you stick with the position. Next, we've got Altria sitting at $43.36. I have 320 shares at $13,875. Average cost is $47.27. Around 26% of the portfolio is in Altria. Today we're down $81. Total, we're down $1,200. Not down as far as we were given like a week ago. So that's kind of come up a little bit, which is nice. But we do have a dividend coming in on April 30th. So right at the end of the month, we have $313.60. So guys, this is the biggest payer in the entire portfolio. So, and this is one of the companies that I'm excited to get paid from so much, because I could either buy like 6 or 7 shares of itself. I'm dividend efficient. Or I could go buy at least 1 share of Visa for that around 287 to say $300, or I could buy something very close to being able to buy something like Berkshire with this dividend, given the fact that I have about $100 sitting in cash in the portfolio, as well as I do have that Realty income dividend of $40 coming in, so that would cover a Berkshire Hathaway share. So that's one of the things that I'm super excited about. This is a prime example of exactly how powerful dividend income can be. Next, we have Apple at $170. So we have 1 share. Market value, of course, reflects the stock price at $170. $132.66 is our average cost. 0.32% of the portfolio is in Apple. Today, we're down $1.50. Total, we're still up $37. We have a 28% return on Apple. So guys, this is one of the smaller positions, just like Coca-Cola. Now, the reason is a little different as to why I haven't bought this. Because I'm up so much, I don't want to keep buying it as that price goes up, right? So this is a little bit different than Coca-Cola, because Coke was only up a few cents. This is up nearly $30 per share, and I want to get it back down to like 140 before I purchase more. But I do want Apple to be the single biggest position in the portfolio. My goal for position size would be Apple. Then I would prefer it to be Visa. then Coca-Cola, because I do love Coca-Cola. It's one of my favorite companies. Then I would be happy with it either being Berkshire or Google in that 4th and 5th spot. Now, of course, it might be Abbvie for a while, because as of right now, the biggest positions, I believe, are in order from like Altria. Then I believe it goes Altria, Abbvie, Trow Price, and then Realty Income. So it'll take a lot of capital for a position like Apple, Visa, or Coca-Cola to overtake those. But the beauty of the portfolio is those companies that are really large right now are going to fuel the growth in the positions of Apple, Visa, Google, and Berkshire as well. So Apple will be the single biggest position. And I do want to stockpile some cash, so when it's around my average cost, I can kind of pull in Abbvie and just pour money into this quality company. Next, we've got Abbvie. So it's sitting at $180 per share, down $1.91 today. But we've got 95 shares, $17,000 worth of market value. Average cost is $95.19. 32% of the portfolio is in Abbvie. Today, we're down $181, down 1.05%. Total, we're up over $8,000. We have an 89% return on Abbvie. So guys, this is one of those companies that I put about I think it's like 8 or 9 grand into, right? So I'm up more than, or even to what I put into it. So I've more than doubled my money on this position. So this is one of those that it started off as a relatively big position, right? It was around 10 grand. Now it's sitting at nearly 20. So I think it was around $8,000 or $9,000 that I put into the position. But this is one of those companies that it started out as a relatively large position, but due to the fact that the company's not only grown in stock price, but it's also the dividend has grown exponentially as I've held it as well. So this is one of those really good examples of why you hold quality for the long term. This is one of my earlier stock investments. I believe it was in like mid 2018 into early 2019. So I've held it for quite some time. I've never sold a single share, and I've been paid handsomely for that. So if you guys can analyze a company that you're comfortable with, that you understand, and that you think has a steady track record of growth, that's what you want to own. You want to own those quality companies that you never want to sell. That is a 100% influence from Warren Buffett and Charlie Munger, saying you do, and Peter Lynch as well came up with this, but you do not cut your flowers to water your weeds. So I could sell out of Abbvie, right? And I could put it into, like something like Trow Price. It doesn't necessarily mean that Trow Price is a worse stock, but why would I cut the growth short of such a quality company? Next, we've got Trow Price. Now, it's at $120 per share and 34 cents, down about $1.60, 1.3% today. We've got 100 shares, $12,000 worth of market value. Average cost is around $110 per share. 22% of the portfolio is in Trow Price. Today we're down $160. We're up over $1,000, a little bit over $1,000, about a 10% return on Trow Price. And guys, this is one of those companies that, again, like I said with Abbvie, if you can analyze individual companies and you can understand why they go up and down. So like with oil, a lot of times it fluctuates due to the demand in oil prices, whether it's going up or down, and their cash reserves. So if you can analyze a company and understand why the company fluctuates, and you can analyze and say, look, Trow Price is a great business, but it's pretty much, think of it like a brokerage firm like Vanguard or Fidelity. They have mutual funds that people put their money into, and then Trow Price makes money off of the assets under management and the fees that they collect for owning those assets because people put their money into them. So that generates fees for Trow Price, and then that's how they get more assets under management. And so the more clientele they have, the more fees they get, the more money they make. And then, of course, that rewards shareholders and the business grows. Or if they lose clientele, or the economy drops, if the overall economy gets sour, something like that, it fluctuates based on the overall economy and investor sentiment. That can be dangerous if you don't understand the economics of the business. So say when like COVID hit and the stock dropped to like $80 a share, if you were a shareholder and owned it at 200, because that was the former 52-week high, say you owned it at 200, it drops down to 88, you don't understand the business, you just put your money into it because say it's a dividend aristocrat, or maybe you heard the name of a stock on the bus, or you saw it on the ticker slide across on CNBC or something like that. You don't understand how a brokerage is run or what business they're in and the economics behind that business. When it goes down to 88, you're going to freak out and say, you know what, oh my God, Trow Price is losing so much money. I don't understand the business well enough, and I don't feel comfortable owning it at 88. And you sell out and say you bought it at 200, you lose, say you lose like $100 per share. That's a big loss for you. So it's very important that you are honest with yourself as an investor, because there are some companies that I don't understand. I'm still trying to, fully comprehend Facebook. That's why my money's not in it. I understand the business. It sells ads to its users on its platforms. It does not have to create content, but there's just some logistics within Facebook that I'm still a little uneasy about, so I haven't jumped into that position yet. So every company that I own, I've done a deep dive on. I like the management, I understand the business model, and most importantly, I understand the economics behind the business. That, I think, is the single biggest and most important part of investing, is that you have to understand every single company in the stock market, regardless of what it is, regardless of if you think it's the best company in the world, regardless of the name, who runs it, it doesn't matter, XYZ company, every single company in the stock market is going to fluctuate. And if you can't handle those individual fluctuations, you should not own individual stocks. As well as if you don't have the time or the interest to investigate these companies at a pretty deep level, then you shouldn't be investing in individual stocks. There's nothing wrong with owning the S&P 500. There's nothing wrong with owning SCHD or SPY or VU. There's nothing wrong with mirroring the index if you don't want to analyze individual companies, or you don't feel comfortable owning a single company because you don't like the fluctuation. In fact, most of the time, that's the right thing to do. I mean, most of my funds, that like as in my capital, I probably would have performed better if I were in the S&P 500 instead of owning something like Altria that's down right now. The market's up. See what I mean? So I understand that it takes time for companies to bounce back, but I've also been able to identify something like Abbvie and beat the overall market and make a good compounded return. But it doesn't always work out as smoothly as you want it to as an individual investor. So this is one of those rare instances where I feel like this Trow Price could be another Abbvie, because there's been a lot of bad, market fluctuation, overall economy. People are freaking out, right? And I understand the economics of Trow Price, right? They are still collecting fees from their mutual funds. So, and they have steady revenues, they have great management, they're great at capital allocation, they're good at reinvesting back into their business, as well as they pay a growing dividend that is safe. They have a low payout ratio, which means that they have plenty of funds to reinvest back into the business, and they have a pretty steady and reliable growth trend. And even when they don't, as in when COVID hits, or if there's if people are being laid off, however that fluctuates, I understand the business well enough that I'm not going to freak out and just sell it. So if you have the ability and the time and the interest, you can really make a lot of money when it comes to individual stocks if you truly understand them. But if you don't, and you're going to shoot yourself in the foot and sell it at 80 instead of holding it for the long term when its high was 220 and you don't understand the business, that's where investors get bit in the ass, because they overestimate how much confidence they're going to have when the market fluctuates. And speaking of Trow Price, the reason why I'm very long in it is I love the management team, the dividend's growing, the payout ratio is low, and I have utmost confidence in management because they've grown it for over 25 years. They're a dividend aristocrat. And of course, this is the main reason why, is because they were at around $200 per share 2 years ago. That's a relatively short time. That's about half my investing career, right? I've been going for about 5 years, so about 2.5 years. So there's been a lot of fluctuation in the overall economy, but their revenues have been pretty steady. And even when they've declined, they've had very, very good capital allocation. So I'm not worried about it. So I analyzed the company, and I think that it could get back to that $200 level once the overall market recognizes how much of a powerhouse the company is. And I could be wrong, right? If it sits at if it drops down to 80 or only goes up to 125, I'm fine with that too. I'm in it for dividends, right? But I believe that this company overall is going to grow its dividend. Therefore, I'm going to be able to use that dividend to either reinvest back into more shares, because I'm dividend efficient within Trow Price, or I can use that $125 to buy another share of Google, or help me buy Visa or Facebook or Berkshire or Coke. It doesn't matter, right? So I plan on holding this for the long term, and I think overall this could be another 50% plus return with dividends. So I'm super excited to hold Trow Price. And sorry, I know I went on a little bit of a rant there, but that it's super important to be able to be honest with yourself and say, I don't understand Facebook well enough to own it. I didn't understand Amazon well enough to own it. So there are all these companies that go outside of what Warren Buffett and Charlie call circle of competence. So I understand Visa, I use it every day, right? But I don't understand something like NVIDIA. So some people, say it's a coworker at my job says, NVIDIA has gone up 65% this year. You're dumb because you own Trow Price and not NVIDIA. And he might be right. He is right. I don't own the stock. But I don't feel like I'm not dumb for remaining in my circle of competence and being honest as an investor and saying, I don't understand semiconductors. I don't understand microchips, right? I'm not in Intel. I'm not in HP. I'm not in Dell. I'm not in NVIDIA. I'm not in AMD. That doesn't bother me. I don't see a 60% gain in a stock I don't understand as an overall loss, simply because I know I don't understand the economics of that business. So I only count it as a loss as in Trow Price was at 80 and I bought it at 120. That's a loss to me because I understand the business well enough to know to buy it at 80, right? So with that being said, guys, I'll jump to the watch list real quick. And of course, we got Visa. I talked about this earlier. It's down to 177. 52-week high is around 290. So you have about $13 of upside there. But I do plan on buying a share of that before the month is up. I'll use that Altria dividend as long as it covers. As long as Visa's under $300, I'll be adding it. Next, Berkshire Hathaway is one of my personal favorites. They do, essentially what Trow Price does. They use the funds that they own, funds that they produce from businesses that they own and dividends that they own from publicly traded companies to buy more businesses. And they use insurance float to get free money from premiums to buy more businesses. So in a way, it's different, but it's still similar. They run their own hedge fund by owning fully operated businesses that they own, fully owned businesses that they own or operate, plus stocks that they own from public companies. 10% share. They have a huge share in Apple, Bank of America, Chevron, Kraft Heinz, Coca-Cola. They use the income that they get from those businesses to buy more businesses. They're a holding company. So I love Berkshire's business model. Whether Warren Buffett runs this or not, I have extreme confidence in management. Ajit Jain's running the insurance side of it. Greg Abel is running everything else outside of insurance. And I think they have the utmost integrity, and I think that they will run the business very well. And they also have a couple of investment lieutenants that I feel like do a very good job in capital allocation. So I will own Berkshire. It is on my list for the end of the year. And it's one of those that I plan on buying and holding for the rest of my life. Then, of course, we have Meta. Now, I need to do a little bit more information gathering and analysis on Meta, but it is one of those companies. I use Facebook, I use Meta, I use Facebook, so I use products from Meta Platforms every day. I understand the ad business, I understand advertising. I've used Facebook ads before, I've used Google AdSense before, and I think they have an extremely powerful moat and customer base. But the only reason that I have not invested into Meta yet is simply because I feel a little worried about the innovations when it comes to social media and how hard it is to capture people's attention and keep it. But as I do more research, I think I will become more familiar with the company, and I just want to buy it at the right price. So as of right now, I feel comfortable buying Meta. I feel comfortable owning Meta, but I don't want to buy it or own it at this price. The problem that I'm having with Meta is the future overall cash flow. So what happened is they went big on the metaverse and the stock dropped, right? That's why it went down to 80, because Mark Zuckerberg was saying they were spending X amount of dollars. I think it was like $10 billion on the metaverse, right? I'll just throw a number out there, right? And people freaked out and they said, oh, Facebook's going to go down. They don't have this. They can't sustain the capital. They don't understand the future of the metaverse. It's a gamble. And even though I don't think it went how Facebook wanted it to, or Zuckerberg wanted it to, I still think that's the type of innovation I want to be a part of, right? If they have cash flows that are sustainable, that they can keep repeating and putting back into the business, even if it isn't always 100% successful, that is how you stay ahead when it comes to social media. Like Snapchat, I know a crap ton of people use that platform, but the stock hasn't gone anywhere, right? Because they don't innovate very well. And the other thing is they are so predetermined based upon celebrity sentiment that their stock price, I think it was Kylie Jenner or something, said she hated a Snapchat update, and it dropped like 42%. It went from like $22 to like $8 a share. Like, how are you supposed to remain a profitable company when you don't control your own destiny, right? So I will say that about Meta, is that I think they have, one, stayed competitive and innovative enough to head that market and have a competitive moat. I just don't like them at around $500 a share. I want to get them around 200. If I could get them lower, or at or lower than that, I would purchase a big block of stock, just like I did with Abbvie. So guys, with all that being said, I just want to say thank you so much. The portfolio has been growing, the dividends have been coming in, but the channel has been growing so well, and I really do appreciate it. I went on a break for almost a year, and I missed it every single day. And just the overall growth that we've had, the support that we have on the channel, and this great community, I'm so thankful for it. Guys, I started this because I needed something to get myself through a breakup, to be completely honest, right? To be forthcoming. And I love sharing my journey so much, and I appreciate that it's grown into almost 700 people, which is crazy. I'm just a kid from Iowa that started investing because everybody told me I was stupid to start. I had a girlfriend at the time told me I was dumb. My parents thought I'd lose money. My friends told me I was dumb. And now I'm 28 years old with $53,000 invested, and it just keeps growing every month. Whether the price of the portfolio goes up and down, whether the total value goes up and down, that's fine by me. I'm not influenced by market fluctuations. I want to buy when stocks go down. But my main goal is to build a portfolio that produces income that I can live off of. So every single month, and you guys can see that buying power right there, $98. Every single month that I get paid a dividend, I want my passive income to grow. That's the goal of the portfolio. And I want to thank everybody that's tuned in, that's checked out a video, that's liked, that's commented to say they didn't like it. I want to thank you guys for being on the journey with me. So I just want to let you guys know that I'm appreciative, and I will see you tomorrow with another Robinhood portfolio update. Take care, guys.